Hello student, we are in the 6th video on the topic of terms in accounting. Let's check out the terms that we will cover in this video. 30th term, books of account. 31st term, entry. 32nd term, debit. 33rd term, credit. 34th term, depreciation. 35th term, cost of goods sold. 36th term, bad debts. 37th term, insolvent. 38th term, solvent. 39th term, book value. And the last term is balance sheet. Let's check out books of account. 30th term, books of accounts. The books in which transactions are recorded is called books of accounts. So examples are cash book, bank book, journal proper, ledger. All these are example of books of accounts, places where transactions are recorded. 31st term, entry. A transaction or event when recorded in the books of accounts is called entry. So whenever there is a purchase or sale, it is a transaction and we will make an entry in the books of accounts to record the transaction or event. So the recording of the transaction or event is called making an entry in the books of accounts. 32nd term, debit. The left side of an account is called debit. It is derived from the Italian word debito. Now we've already seen when we saw the term of account that account is a T shape. Now let's say we have cash account. Now in any account, the left side of the account is called debit side. When we record transactions on the debit side, we are said to have debited the cash account. 33rd term, credit. The right side of an account is called credit and it is derived from the Italian word creditor. So let's take the same example as we took for debit. Let's say we have a cash account. The right side, which is this side, is called credit side. When we record entries on the right side, the credit side, we are said to have credited the cash account. 34th term, depreciation. Depreciation is the fall in value of fixed asset. It could be because of constant use. It could be because of passage of time. It could be because of accident or technological obsolescence. So this is called depreciation. The fall in value of the fixed asset due to constant use, due to wear and tear, passage of time, accident or obsolescence. This actually refers to allocation of the cost of the fixed asset to each accounting year over its useful life. So we'll see an example how the cost of the fixed asset is apportioned over its estimated useful life. Now let's say a business purchases a machinery for 10 lakh rupees. Let's say it is estimated that the useful life of the machine is 10 years. Now, the business cannot show rupees 10 lakh as expense for the year in which the machinery is purchased. Why? Because the benefit of that expenditure of 10 lakh is going to accrue for the next 10 years. So, the cost of the machinery of 10 lakh has to be spread over its estimated useful life of 10 years. So, when we spread the 10 lakh over 10 years, every year we will write off as expense rupees 1 lakh. So, this is called depreciation, where we allocate the cost of the fixed asset rupees 10 lakh to each accounting year over its useful life of 10 years and show over 10 years rupees 1 lakh as depreciation or expense every year. 35th term, cost of goods sold. It refers to the direct cost attributable to the goods sold or services rendered. So, all direct expenses which is related to the goods sold or service rendered will be added up to find out the cost of goods sold. Thirty-sixth term, bad debts. Bad debts is the amount owed to the business which is written off because it has become irrecoverable. It is a loss to the business and therefore debited to the profit and loss account. Let's say rupees 1 lakh is due to the business by some debtor. Due to some reason, let's say the business will not be able to recover the 1 lakh. Then this rupees 1 lakh will be written off as bad debt. And this amount will be debited to the profit and loss account, showing that it is a loss to the business. 37th term, insolvent. A person or enterprise who is not in a position to pay its debts is considered as insolvent. So, a person or enterprise who is not able to pay whatever is payable by that person or entity, then he or the enterprise is referred to as insolvent. 38th term, solvent. A person or enterprise who is in a position to pay its debts is called solvent. So, if the person or enterprise is able to pay whatever is due by that person or enterprise to others, then the person or enterprise is considered as solvent. 39th term, book value. The amount at which the item appears in the books of accounts or financial statements is called book value. So, let's say a particular machinery appears in the balance sheet on the asset side at rupees 1,50,000. Then the book value of machinery is said to be 1,50,000. So, that is book value, the amount at which an item appears in the books of accounts or financial statements. The 40th term, balance sheet, the last term in the topic of terms in accounting. It is a statement showing the financial position of an individual or enterprise at a given point of time. It shows the balances of assets, liabilities, capital reserves and other account balances at book values. So, a balance sheet is a statement showing the balances of assets, liabilities, capital reserves and other account balances at book values. So, with this we finish this video on terms in accounting.